Over the next few days, the U.S. stock market faces a massive shift in momentum. A small window of time is about to dictate the financial direction of the entire economy. Investors typically look toward the Federal Reserve or the latest inflation report to explain market swings. However, those standard macroeconomic levers are currently being overshadowed by a much tighter set of corporate data. Market attention is narrowing on a few specific names, the leaders in artificial intelligence, cloud computing, and semiconductor manufacturing, as they prepare to release their quarterly earnings. These technology giants exert a gravitational pull over the rest of the market. Their quarterly reports possess the power to reprice trillions of dollars in market value almost overnight. If you don't day trade or pick individual tech stocks, it is easy to assume these corporate reports happen in a vacuum that doesn't affect you. But everyday financial vehicles are built on these companies. If you contribute to a 401k, an IRA, or a pension fund, you likely hold a significant stake in this tech ecosystem. This chart represents a standard S&P 500 index fund. Being market-weighted means a company's size dictates your investment. Because a few tech giants take up disproportionate space, a sharp drop in their value drags down the entire index and your retirement balance along with them. The chain of exposure is direct. The numbers reported on an earnings call this week will show up in the balance of millions of everyday retirement accounts by Friday afternoon. To understand the stakes, we must look past spreadsheets and examine the physical scale of the infrastructure required to build modern artificial intelligence. Major tech firms are currently pouring billions of dollars into capital expenditures. They are rapidly building data centers, buying thousands of specialized processors, and securing the required energy grids. This earnings week provides a clear window into whether that spending spree is actually paying off. Wall Street is looking for three specific metrics: tangible AI revenue growth, expanding profit margins, and earnings per share, the actual profit allocated to each share of stock. The market is using this data to answer one question: is the massive financial gamble on AI generating enough real-world cash to justify the cost? For many investors, simply reporting high profits for the previous 3 months is insufficient. Earnings season frequently produces outcomes that seem to defy logic. Watch this common scenario. A company's revenue line climbs to a record high, yet its valuation drops off a cliff when the report releases. This crash happens because of future guidance. If management issues a cautious projection, investors instantly discount those record profits. Financial markets are forward-looking. A single sentence from a CEO about slowing demand will erase billions in market value, regardless of how much money the company made last month. These price swings rarely stay contained. They trigger a contagion effect, where one company's results instantly impact the valuation of its partners and competitors. If a major semiconductor manufacturer reports strong results, it signals high demand for chips. This instantly drives up the stock prices of the cloud providers buying those chips and the software companies building tools with them. This effect even extends into sectors that don't have public earnings calls. In aerospace, the market is heavily influenced by privately held titans like SpaceX. Even without a public filing, a major funding round or a successful launch from SpaceX dictates investor sentiment for the entire publicly traded aerospace industry. These technology subsectors operate as deeply interconnected ecosystems. A single catalyst from one player ripples outward to reprice the entire landscape. Stripping away the metrics and spreadsheets reveals that earnings week serves as a real-time measurement of human psychology. These reports act as a barometer for global confidence. They show whether investors still trust in corporate spending and the potential for future economic growth. This week specifically forces a reckoning. It is the moment to see if investor belief in the AI-driven growth narrative can survive a cold look at the balance sheet. By understanding the chain of exposure, from a CEO's comments to your own index fund, you are better prepared for these sudden market swings.
Staying informed on these mechanics helps you understand the headlines before they move your money. If you want more fact-based breakdowns of the U.S. economy, subscribe to the channel, and we'll see you next week.